My take on it is that if you're not leveraging AI in the operations, you're going to fall behind.
On this episode of the Going Passive podcast, I'm interviewing Holden Chang. Holden is a multifamily operator in the Houston marketplace, and he's here to tell us a little bit about his current portfolio and what his new opportunity is over in Houston. Holden, thanks for coming. Thanks for sitting down with us today. Let's just kind of start off with an overview. Give me an introduction, a little bit about what your current portfolio looks like, how long you've been an operator in the Houston marketplace, and kind of how you run your business overall. I know you do some unique things, certainly in the multifamily space. So maybe open up with that.
Yeah, my wife and I are investors. We invest in a broad set of assets ranging from VC funds, startups, all the way to art. But about 6 years ago, my wife and I decided we wanted to use some of our expertise and build a company of our own, build a business of our own. And we investigated a lot of businesses ranging from food service to manufacturing. But we decided to go with multifamily because of the risk profile that it has. It's a real tangible asset with a very known return profile and known modeling. So we dove in. We got a lot of help, mentorship, training, networking, and since then we got in about 2021. We started in 2020 looking for deals, maybe even before that. But in 2021 we closed on our first deal, and many folks may know that 2022 was the peak of pricing in multifamily. So we bought one in 2021, and we bought another one in 2023. And because of the way we structured the deal, we didn't think that we were hot shots or anything at the time. So we structured them very conservatively, low leverage, conservative operational modeling. And so we did well, and we've been distributing consistently throughout the life of those deals. One of them, in fact, won Property of the Year for all of Houston with the Houston Apartment Association, which is the largest apartment association, by the way, in the world. And so we're very proud of that. And so we're looking at our next deal.
Sal, how many units do you have under contract currently, or under operation currently?
Yeah, so the two deals that we have combined are 100 units. So one of them is 56 and the other is 44 units.
Okay, so they're small to mid-size opportunities, kind of below the institutional threshold. Is that where you like to operate?
Well, since these were our first deals, we wanted to make sure we could do them well. We also made the decision to take on investors for those first two deals, and that's another reason why we modeled them conservatively. And so we could have done larger deals. And looking back, I'm glad we did it the way we did. It's smaller deals a little bit tougher because you don't have as much staff to work with, and so I have to step in every once in a while. But after 5 years of operations, we're ready to move above that.
Hey, it's Doug Tabor, CCIM, multifamily broker and host of the Rental Market Update. If you're like many of my clients who've owned rental properties and apartment buildings for 5, 10, 15, 20 years, you're most likely tired. Maybe you're tired of the tenants, the telephone calls, the toilets, the turnover, and what you're looking for is maybe a little more time off, travel, tranquility. That's why we've created the new webinar, Mastering the Exit. Sell your rentals, defer your taxes, and reinvest into passive income streams. Spend 60 minutes with us as we cover going into a 1031 exchange and looking into more passive options. Maybe you're going into more apartment buildings in another market. Maybe you're looking to reinvest into a net lease asset, or you're interested in a Delaware Statutory Trust or DST. Or maybe you have a favorite charity and you want to learn more about the Charitable Remainder Trust. Take the hour, register for this free webinar, learn more about what your options are so you can get away from the terrible T's and focus more on the terrific T's. Why don't you walk us through your last deal? I know you raised money on it. Tell us how much you raised, tell us about the transaction, and then what actually happened versus what you had projected.
Yeah. The last deal was a 44-unit property. In fact, it's the one that's two blocks away from the one we're raising capital for right now. That one we raised $2.5 million, and we raised most of that in 24 hours. Now, that deal didn't go as smoothly as I had hoped. It took a bit longer to do the construction, and mainly because I tried to do it myself. I tried to find all the individual workers myself, so that's very different from how we have this one, where I vetted out 4 different construction companies. I got 2 solid bids, and then I committed to one where they just got I have a very good, I guess I like their proposal. They're very detail oriented, and I like their strategy on how they're going to approach this. They have a very strong track record as well. The other thing that didn't go as planned was the cap rates. The cap rates decompressed significantly. And that was not in my modeling. And thankfully, we did not borrow a lot of money, and so because of our low leverage, our low LTV, we're still cash flowing. We've never missed distribution. We did delay distributions by a couple months in the very beginning, and that's it. Ever since then, we've distributed. We've never had a capital call on any of our properties. Both properties have distributed consistently ever since they started distributing.
Yeah, off camera, you and I have been talking back and forth for several years now. We've known each other, certainly in the industry. What I always like about our conversations after speaking years and years and years with independent owners is, a lot of these properties are operated kind of just the old school way. When I look at rent rolls and when I look at income and expense statements, sometimes they're even just written out by hand. What I think was interesting with regards to how you were modeling projections, you were really starting to bring AI into the space. You were really starting to bring technology. Tell us a little bit about what you're doing with technology and how you plan to incorporate that into the success of your investments.
Well, AI did not exist in the form that it exists today when we first started. So a lot has changed in the multifamily in the world, really, in the last 2 or 3 years. When we first operated, we had to do everything by hand. Now we used management software and we used spreadsheets. We used the technology that was available at that time. We use it in everything from data analytics to understanding our resident profile, and also in our playbook on how to reach out to the market and reach the type of demographic that we want to get for our property. The sticky kind, the folks that have stable income who match our property profile best.
And what's the growth looking like in Houston right now? I mean, Houston's a giant MSA. I don't know, it's like 6 to 8 million people. It's huge. Everybody's flocking to Texas. Why Houston and why now as far as buying another investment opportunity there?
Yeah, Houston has always been known as a very business-friendly city. People criticize its loose zoning policies, but that actually creates a very real estate friendly climate or environment. So there's been a lot of development in Houston, and that's created the space for population to move in. And so in 2024, from 2024 to 2025, Houston was actually the #1 metro in the entire U.S. for population growth. And in 2025, it led the nation on job growth as well. I think it was about 10 times the national average on job growth. So jobs Jobs are here because the companies, businesses are moving here. It's Texas in general has a very business-friendly climate, and workers love this place because they don't charge a state income tax. Um, in 2021 to 2023, those 2 years post COVID, 2 or 3 years, Houston actually had the number one GDP growth in the entire nation. So it led all major U.S. metros on GDP growth. There's a lot of things that Houston has that people don't. I guess people have overlooked. People overlook that the fact that it's the energy capital of the world. All the energy companies are here. It's got the largest medical center in the entire world. The second place is like a far second. It's one of the leading manufacturing bases in the U.S. And I like to say this every once in a while, that it's a space capital. I mean, they didn't say, Cape Canaveral, we have a problem. They said, Houston, we have a problem. Houston is known as as a space capital as well. And so it's got a lot of real tangible businesses and economies that draw businesses and draw people here. And it's also one of the reasons why a lot of California or a lot of the population from California has moved over to Texas. I think it was like 560,000 from California alone in a span of a few years.
Yeah, very interesting. Great play on the fact that it's the space capital. I never really thought twice about the idea that, yeah, they do say, Houston, we have a problem. And we're recording this, of course, on the eve of one of the biggest IPOs in history, the SpaceX IPO. So, certainly there's going to be more and more growth there. And I do totally agree with you. Whenever I'm looking at a market, I'm always looking, number one, focused on, unemployment rates, on job growth. And certainly, you can't pick up, I was going to say pick up a newspaper. How cliche is that? You can't open up a news site without them talking about how much growth is happening in the state of Texas. So that certainly makes sense.
If you think about what's important in the next 5 or 10 years, it's going to be manufacturing, energy, medicine and healthcare, and space. And Houston is number one in those sectors. You could add food, and there are some metrics that show that Houston is the number one exporter of agricultural products. So if you think about what the world needs in the next 5, 10, 20 years, Houston's got it.
Yeah, those are all good points. Tell me about the regulatory environment in Houston. Of course, I come from California, and we have the worst regulatory environment, especially with rent controls. I mean, maybe second only to New York. But tell me about how it is to operate multifamily within the greater Texas area, and then, of course, Houston as a metro.
Well, in housing, one of the biggest issues, especially in recent times, is when someone doesn't want to move out and yet they're not paying their rent. That's a big problem in places like California and New York City. In Houston, or in Texas in general, has very landlord-friendly policies. It has softened a little bit, and when I say softened, I mean it used to take just a few weeks to evict someone, and now that's probably expanded by a week or two. So we're still looking at 5 weeks from filing the eviction to having that person out of the unit, so that you can put someone in there who's actually paying rent and operate your business like it ought to be operated.
Got it. So it's softening a little bit, but compared to some of the extremes in the other states, I mean, in California, it's 3 months, and you have to pay them to actually move and practically drive the U-Haul for them to get them out. So 5 weeks isn't bad. Trust me, I have a lot of people that are going to be listening to this thinking, oh, yeah, that's not bad at all. All right. Well, tell me a little bit about the deal. Tell us about the opportunity. I think you had presented this to me as more of a economy of scale because the properties are near each other. So tell me about the property and what the plan is.
Yeah. So one of the things I love about this specific property is it is situated right in between both of our properties. It's right in between. So, when we underwrite this deal, we underwrite it as an independent property, as if it needs its own staff, its own resources, and it's got no outside help. It's a standalone business. However, the reality of it is it's got two properties right next. One of them right next, like 2 blocks away, and the other one is a 7-minute drive. That if we needed extra hands on deck, or if I needed to let go of someone, I could borrow staff from another property. We could borrow resources. Instead of buying a sewer machine for each of the properties, I only need to have one. I mean, you only use these things once every few months. So you don't need to buy all the equipment for that property. If it's missing a part for an AC or a electrical part, and that property doesn't have it, it can. So these are the things that economies of scale offer. I like to use the analogy of monopoly. Monopoly. When you buy 2 or 3 properties next to each other, you can do things with that group of properties that you couldn't do otherwise. We've known this for hundreds of years. We've known this, and yet that art seems to be lost in the multifamily space because people are just chasing for whatever deal they can get their hands on. It's part of our company mandate is that we buy the properties in clusters. So it's a no-brainer. With this deal, you can, because we're buying this in proximity to our existing properties, we could, in theory, the rents could drop and cap rates could expand, and we could make just as much money in theory. So, but we've underwritten this deal as if it's an independent property. So that's one of the things that I love about it. The other thing is that the cost basis on this deal is it's $55,000 a door against $90,000 to $100,000 for current or recent transactions in the area, in that submarket. So in that submarket, I know people who have transacted near the $95,000 per door mark, and we're getting this at $55,000 a door. It's like a 40% discount on the within the submarket. When we underwrote this deal, we didn't underwrite big rent bumps. People have been struggling with rent bumps, so we thought we just don't know what the future is going to look like. We didn't underwrite it with lower cap rates, so we did a pretty high exit cap rate for this area. This area is using. We've seen valuations using a 5.75. Cap rate, 5.75% cap rate, but we're doing a 6.5% cap rate. People ask me sometimes, what happens if this catastrophe happens or that catastrophe happens? I ask them, what's the worst thing that can happen to a multifamily property? What's the worst thing that can happen? The place burns down. There's a massive, shooting, a death. I would argue from a business perspective, from a business point of view, the most catastrophic thing that can happen to a property is cap rate expansion. Because now you have, let's say, a $30 million property that is worth $20 million.
Sure.
Just because of nothing that you've done. You could have operated it even better than ever before. But because of cap rate expansion, you lost all of your money because of market forces, because it had nothing to do with crime. It had nothing to do with a loss of the asset. It was simply because of the financial state driven by the economy. So that's why we underwrote this deal as if the economy is not going to go well.
Got it. So cap rate expansion, basically net operating income drops or lowers, which causes the cap rate to go higher. And anything that could affect net operating income would be everything from rents to vacancy to things like insurance and taxes going up, expenses going up. How do you plan to turn this one around? I mean, you're getting it at $55 a door. I'm sure there's some turnaround management there. It sounds like it's a value add deal. So what's first off, how many units is it? And then, what is the kind of overall arching plan of getting it back up to that 95 per door value that maybe it'll be 3-4 years down the road?
Yeah. So this is a 138 unit property at
Okay.
55 a door. That's about roughly $7.6 million. It's not perfect. So the property has 19 down units. And the reason they're down is because there was a storm, kind of a horizontal tornado, if you will. They call them derechos. And it ripped the roof off, and then it flooded all the units under that roof. And so that's about 18 units, and then there's another down unit. But really what's the story that's going on is that the seller, technically speaking, the seller died, and then the wife had been taking over operations, and then she became incapacitated, and now the daughter is running it, and I don't think the daughter has any interest in running this property. And so we and she, she's a very nice lady, and she's willing to sell this property to us, and it's actually the last one in their portfolio. And so we're I think that's one of the reasons why we're getting it at such a steep discount. Now 20 or 19 down units might sound hairy, and it is. And that's why we got 4 construction companies out there to take a good look at it. We hired engineers. We had a due diligence team of over 15 people scour the property inside, out, top to bottom, roof, drone, underground with pipe cameras, sewer cameras. And so we have a really good idea. This is an older property, so you really need to understand the risk as best as you can with these older properties, and we feel good about it. And even though we have a good idea of it, we have set aside a good amount of money as contingency, just in case just in case we miss something or something happens with these old properties. And so the 3, I call them levers, that we're going to pull to drive value creation, if you will, are to fix those down units. We're going to rebuild those 19 down units, and we have we actually have 2 firm general contractor bids, so we know what the pricing is to fix those units. We have the pricing on those with precision. Another thing there are some, you could call them bookkeeping or booking issues with this property. One of them being the taxes, and the other being insurance. Now, the tax appraised value. So we have to pay property taxes on this deal. And the amount of property taxes is based on the tax appraised value. Now, the tax appraised value on this property is about $11 million, but we're buying this at 7.6. So all we have to do is take that purchase price to the appraisal district and tell them this is what we purchased it at, and they're going to appraise the property on what the market value is. But by definition, the market value is what you bought it at. So they're just kind of reset it down to 7.6 million. The insurance, because they filed a claim on the roof and the flooding of those units, the insurance shot up to about $2,500 per unit. We have a commitment at $1,450 per unit. It's a significant drop, and in a couple years, when we have a longer a clean loss run. What a loss run is, it's a record of what losses have occurred on that property over the past so many years. Once we have so many years of no loss runs, that means we haven't filed any insurance claims during those years, the insurance drops. And right now, if this property had no loss runs, we could get insurance for $600 to $700 per unit. So we're going from $2,500 down to $1,450, and eventually down to maybe $800 a unit. Okay, but for now, we're just taking it down to, let's say, 1450, and we're taking the taxes down. Those two alone will save us $100,000 a year. Now, you might think that's just $100,000. Well, you take that with the cap rate that we're going to sell this at. Remember, the value of this property is based off what the NOI is. By saving $100,000 just on taxes and insurance, it boosts our NOI by $100,000, and that creates $1.5 million of value. The units that we're going to restore, that's going to add 200,000, at least 200,000. Conservatively speaking, that's 200. The 19 units is probably going to create more than 200,000, but that would $200,000 would add $3 million of value to this property. Just those down units being restored. And finally, we're going to get the rents normalized. So their occupancy is low, and if we just get rents up toward what they're saying the rents should be. So in their own books, in this property's own books, they're saying rent should be about $1.17 a square foot. But I said, I don't trust that. Let me see the bank statement. So in the bank statements, I'm seeing it's more aligned with $1.02 per square foot. So $1.02 versus their claimed $1.17. Well, if we just take it to $1.12, if we would just take it from $1.02 a square foot to $1.12, that adds $150,000 of NOI per year, which equates to $2.3 million of created value. Now, just a side note, my property just 2 blocks away, and also the one that's 7 minutes away, those two properties are achieving $1.63 a square foot. So we're going from $1.02 to $1.12 when my properties are getting $1.63 nearby. So this is truly we're just keeping rents stagnant. We're just assuming the worst case here. This is a very base case scenario. And so the returns on this are 1.8 return on multiple based off this base case scenario. That's a 16% average annual return, 6.5% cash on cash. After the first year, we've got to restore those units. But after that, you get 6 to 7% cash on cash, distributions, and we distribute quarterly.
So tell me about so you distribute quarterly. We're going to talk a little bit more about the money aspect of it, the return on the investment. But tell me a little bit prior to going into that, what the debt's going to look like. You said you were going to do low leverage. Tell us about what the debt. Are you going to assume debt, or are you going to go out to the market for new debt?
Yeah. So one of the things that kept us healthy in the first two deals is that we didn't borrow a lot of. We didn't have a high LTV, what we say, and we had somewhere close to 60%, which is considered very low.
Very low.
And the bank, and I want to note, the lender said, you can borrow more. We encourage you to borrow more. And I said, well, I just want to play it safe. We don't need to make a killing. We're not trying to hit a home run here. We just want to feel safe in this deal. And they're like, okay, well, it's your choice. Well, that saved us. That really did. So but because this one has such a low cost basis, we're going to go for 67% LTV initially. So that's a $5.1 million loan. All in, we have $9.8 million. So again, we're buying this for $7.6 million. 7.6. We're borrowing 5.1 initially. Now, as we fix things and as we restore those units and dress up the property, the bank will give us another $900,000. In fact, they'll give us even more than that, but it's our option whether we want to take it or not. Again, I tend to be a little bit more on the conservative side, but it's there. I mean, it's good just in case money. It's good contingency money. But we're targeting a final loan amount of about $6 million on a 9.8 all in. So once again, we're in that 60 to 70% LTV range.
I mean, yeah, that's certainly a safety range. So is that 5-year financing that they're looking to offer you on whatever the interest rate is at close?
Yeah. So this is a bank loan. It's 5-year fixed. The interest rate is 7%, And
Okay.
we could have gotten a little bit lower, but then that means we got to take more exotic terms. We may have shorter, it may not be fixed, it may be floating rate. And as you
Sure.
know, right now they're raising interest
Not a
rates.
good
So,
idea. Right.
and there's a lot of speculation that it's going to go up even further. We don't know. The thing is, if the deal works at 7% and interest rates go down, we can always refinance to a lower rate and lock that in later on. But if we are stuck in a floating rate situation and the rates go up, we're in trouble, and that's what happened to a lot of deals from 2022 to 2025. They got stuck in these floating rate loans, and they couldn't exit, they couldn't refi, and it's sad. A lot of people lost their money on that. We're coming in with that perspective. We know people who've gone through that, and so we structured it in a way where this can withstand economic cycles. It can withstand it can withstand a lot of surprises.
Sure. And you're actually safer than the guys that were buying in 2021 and 2022 because they probably underwrote to those lower interest rates, and now I'm seeing a lot of those, especially the 3 years, start to come to a time of expiration. And I've been talking to some investors, and it's been rough. Let's just say that it's been rough. So coming in at the tail end of this market correction on multifamily, and being conservative on your underwriting, and certainly not taking the bank on all the debt they want to just strap on you is all well played. So an investor comes in, what kind of investment are you looking at from the average investor, and what would their return look like roughly, and what would those distributions look like? What's the overall plan as far as taking care of the investor?
Yeah. So we are targeting a higher minimum. We're targeting a $200,000 minimum. We'll consider lower amounts. We'll definitely consider lower amounts, but just know that the higher amounts would take priority, and that's just simply because we don't want to spend our focus on managing the investors. We want to spend it on operating well, and having 100 investors it becomes a distraction when we really should be focusing on delivering a bang up job for our investors. So with that being said, we even have a tier for folks investing $500,000 in that they'll get preferred returns. So that at the $500,000 level, you get 7% preferred returns, and there's a catch-up provision for that at the end of the deal during the exit. And what you can expect, whether you're 200, 500, or more or less than 200, is the same in that you can expect a 1.8. What we're projecting is a 1.8 return on equity invested. So on the investment amount, on the capital invested. So that means, for example, I'm just going to use $100,000 as an example. If you invest $100,000, we're projecting that after you get all your cash and cash distributions and we sell the deal, all that added together, you would get $80,000 on top of the $100,000 that you invested. Now, the way it's structured, though, is that you invest $100,000. The first year, there's no distributions as we ramp up those units. The construction company, they have a timeline to finish all 19 units in less than 6 months. So we're hoping to rent a good chunk of those down units out or restored units out within the first year, and start distributing immediately after that. After that, you can expect 6%, maybe the second year, and then 7%. Now, our internal projections show that it goes even higher than that. But it's just hard to say. You just don't know what it's gonna look like in 3 or 4 years. But the deal is structured so that it delivers between 6 to 7%, with stagnant rents, with a high exit cap rate. So the exit cap rate it really doesn't matter until we sell the deal. When we sell the deal.
Sure.
If the cap rates are at 6% or at 5.5%, everyone's going to be a winner. That's going to be huge. But if it goes up to 7 or 8%, we have modeled that case as well. So we have modeled it where rents go down. If rents go down, which I find kind of difficult when we're starting at $1.02, but if the rents go down, we're seeing a 1.5 or 1.6 multiple on invested capital. If the exit cap rate goes up to 8 or 8.5%, we're seeing the same thing. We're seeing a return on invested capital about 1.6, 1.5, 1.6. So I would say I don't know of many deals where rents can go down or the exit cap rate can go up to 8% and you still make money. This is one of those rare deals where, again, we started this conversation with what I love about this deal. It's between both of our properties, and it's got a very low cost basis of $55,000 a door against the $95,000 a door in that submarket. And that's really why this works.
Yeah, that's incredible. That's like 40% cheaper. Very cool. Well, I wish you the best success on this transaction, on this deal. I know that you're kind of in the throes of it. It sounds like you have some of your family's personal investments in it, and it's kind of go time. So what is the timing as far as this transaction? When do you plan to ideally close? And what do you think the long-term play is going to be as far as an exit?
So we are probably, with the PPMs is being finalized right now. So I believe that's going to be ready by tomorrow. We'll open it up for subscriptions starting next week. And then we'll just close whenever we get enough allocations. So that could be in June. That could be in just a few weeks, or it could be longer. But you did mention this lightly, but we are investing at least $300,000 of our own capital into this deal. We could go up just depending on if we want to close earlier and just get it done.
Perfect. Yep. I'm going to go ahead and put a link in the description that will go not only to your website, but if you'd like, I can put your general mailbox or your email in that link as well, or in that description as well, so people can reach out to you directly. Maybe you can get them some more documentation, some due diligence documentation. You probably have an offering memorandum of some sort. So we'll definitely get that out. And Holden, again, I do wish you big success on this. Like I said, originally when I spoke to Holden, and I've talked to him over the years, I really like the way he operates, as far as he is, amongst other operators that I admire, trying to take the multifamily business from the way it used to be operated into more high-tech operations. And I think that's where operators are going to be able to get better returns out of these margins that keep on getting tighter and tighter from taxes, from insurance. So again, Holden, wishing you much success. And if anybody wants your contact information, it'll be in the description. Thanks a lot, everybody. We'll talk to you next time.
Thanks, y'all.